229% in a single calendar year. While you were arguing with your local coin shop dealer about a 50-cent premium, while you were watching the spot price tick up by 1% here, 2% there, while you were celebrating a $5 move in the physical metal, something else was happening. Something violent. Something that the purists in the silver community promised you would never happen. Coeur Mining didn't just rally. It didn't just break out. It detonated. It delivered a 229% return in 12 months. It outperformed the physical metal by a factor of 3. It outperformed the S&P 500. It outperformed Bitcoin. It outperformed almost every single asset class on the face of the earth. And here's the brutal truth that nobody wants to say out loud to the stacking community today. If you held only physical metal in 2025, you didn't lose money, but you got destroyed. You got destroyed by the opportunity cost. You got destroyed by the leverage you refused to take. You got destroyed by the institutional capital that bypassed the coin shop and went straight for the jugular of the supply chain. Ladies and gentlemen, Asian guy here, and today we need to have a very difficult conversation. We need to talk about the beer miner explosion that is currently ripping the faces off the short sellers and leaving the physical purists in the dust. Because what is happening with Coeur Mining and Hecla and Pan American and First Majestic is not speculation. It is not a meme stock rally. It is the market finally admitting that the metal in the ground is worth more than the paper promises in the vault. They told you that mining stocks were dead money. They told you that inflation would eat their margins. They told you that energy costs would destroy their profitability and that you should only buy physical, because if you don't hold it, you don't own it. And for 3 years, they were right. But the rules just changed. The math just flipped. And the institutions, the BlackRocks, the Vanguards, the sovereign wealth funds, they aren't lining up at your local bullion dealer to buy a monster box of Eagles. They can't. There isn't enough volume, so where are they going? They are panicking into the miners. They are buying the ground. They are buying the reserves. And they are driving prices to levels that defy all historical logic because they know what comes next. They know that when silver hits $85 and then $100, the leverage in these companies turns them into money printing machines. The shocking year of Coeur Mining is not an anomaly. It is a warning shot. It is the market telling you that the easy phase of the silver squeeze is over. We are now entering the phase of extreme dislocation where the paper price, the physical price, and the equity price all start speaking different languages. And if you're sitting there with zero exposure to the miners because you thought they were too risky, you are watching the greatest wealth transfer of our generation happen right next to you. And you aren't participating in the explosive part of it. You are watching the rocket take off while standing on the launch pad. Today, we are going to dissect exactly why the miners are exploding. We are going to look at the institutional flows that are driving this 229% move. And we are going to ask the question that terrifies the bullion banks. If the miners are pricing in $100 silver right now, what happens to the physical market when we actually get there? Let's get into it. Now, I know what the physical purists are screaming at their screens right now. I can hear you in the comments section already. But Asian guy, if you don't hold it, you don't own it. The miners can be nationalized. The government can tax them to death. The CEO can dilute the shares. And you're right, all of those risks are real. But while you were focusing on the risks, the market was focusing on the scarcity. And I'm not talking about the scarcity of the metal. I'm talking about the scarcity of the investment vehicle. Do you have any idea how small the silver mining sector actually is? If you take every single primary silver miner in the world, Coeur, Pan American, First Majestic, Hecla, Fortuna, Endeavor, and you add up all their market caps together, do you know what you get? You get a rounding error on Apple's balance sheet. You get a number smaller than a mid-cap tech stock that sells dog food delivery apps. So ask yourself, what happens when the generalist capital wakes up? What happens when the pension funds, the endowments, and the algorithmic trading desks finally realize that the dollar is dying and they need exposure to hard assets? They can't buy physical silver. Imagine a pension fund trying to buy $500 million worth of physical silver eagles. It's physically impossible. They would clear out the entire inventory of every dealer in North America in 45 minutes. The premiums would spike to 100%. The logistics of storing it would be a nightmare. So they don't buy the metal. They buy the producer of the metal. They have to squeeze billions of dollars of capital into a sector that is only big enough to hold millions. It is the financial equivalent of trying to park an aircraft carrier in a swimming pool, and the water has to go somewhere. And the water, in this analogy, is the stock price. This is why Coeur is up 229%. It's not just because silver is up. It asks because the doorway to enter the silver trade is so narrow that the investors are trampling each other to get through it. And this is where the physical buyer destruction comes in. It hurts to hear this, but we have to be honest. The person who bought physical silver at $25 is sitting on a nice gain at $79. You preserved your wealth, you beat inflation, you were safe. But the person who bought the miners at the bottom, they just made life-changing money. They made the kind of returns that allow you to retire 10 years early. The physical buyer played defense, the miner buyer played offense, and in 2025, offense won. But here's the twist. Here's the part that the institutional algorithms haven't figured out yet. The unobtainium phase we talked about with the physical metal, it is starting to bleed into the miners too. China's document 68 didn't just restrict exports of the metal, it changed the geopolitical value of the ground the metal sits in. If China is hoarding its own silver, if Mexico is talking about nationalizing its lithium and becoming difficult with its silver, then a miner with safe, permittable ounces in a jurisdiction that won't steal the mine becomes the most valuable asset on the chessboard. Coeur Mining is primarily in North America. Hecla is in the US and Canada. The market is paying a geopolitical panic premium. They are realizing that owning a paper contract for silver in London is worthless if the vault is empty, but owning a share of a mine in Nevada is a claim on the source of the wealth. The institutions are buying the miners because they are the only proxy for silver that they can actually fit on their balance sheet, and they are just getting started. Now, I know what the physical purists are screaming at their screens right now. I can hear you in the comments section already. But Asian guy, if you don't hold it, you don't own it. The miners can be nationalized. The government can tax them to death. The CEO can dilute the shares. And you're right, all of those risks are real. But while you were focusing on the risks, the market was focusing on the scarcity. And I'm not talking about the scarcity of the metal. I'm talking about the scarcity of the investment vehicle. Do you have any idea how small the silver mining sector actually is? If you take every single primary silver miner in the world, Coeur, Pan American, First Majestic, Hecla, Fortuna, Endeavor, and you add up all their market caps together, do you know what you get? You get a rounding error on Apple's balance sheet. You get a number smaller than a mid-cap tech stock that sells dog food delivery apps. So ask yourself, what happens when the generalist capital wakes up? What happens when the pension funds, the endowments, and the algorithmic trading desks finally realize that the dollar is dying and they need exposure to hard assets? They can't buy physical silver. Imagine a pension fund trying to buy $500 million worth of physical silver eagles. It's physically impossible. They would clear out the entire inventory of every dealer in North America in 45 minutes. The premiums would spike to 100%. The logistics of storing it would be a nightmare. So they don't buy the metal. They buy the producer of the metal. They have to squeeze billions of dollars of capital into a sector that is only big enough to hold millions. It is the financial equivalent of trying to park an aircraft carrier in a swimming pool. The water has to go somewhere. And the water in this analogy is the stock price. This is why Coeur is up 229%. It's not just because silver is up. It's because the doorway to enter the silver trade is so narrow that the investors are trampling each other to get through it. And this is where the physical buyer destruction comes in. It hurts to hear this, but we have to be honest. The person who bought physical silver at $25 is sitting on a nice gain at $79. You preserved your wealth. You beat inflation. You were safe. But the person who bought the miners at the bottom, they just made life-changing money. They made the kind of returns that allow you to retire 10 years early. The physical buyer played defense, the miner buyer played offense. And in 2025, offense won. But here's the twist. Here's the part that the institutional algorithms haven't figured out yet. The unobtainium phase we talked about with the physical metal, it is starting to bleed into the miners too. China's document 68 didn't just restrict exports of the metal. It changed the geopolitical value of the ground the metal sits in. If China is hoarding its own silver, if Mexico is talking about nationalizing its lithium and becoming difficult with its silver, then a miner with safe, permittable ounces in a jurisdiction that won't steal the mine becomes the most valuable asset on the chessboard. Coeur Mining is primarily in North America. Hecla is in the US and Canada. The market is paying a geopolitical panic premium. They are realizing that owning a paper contract for silver in London is worthless if the vault is empty, but owning a share of a mine in Nevada is a claim on the source of the wealth. The institutions are buying the miners because they are the only proxy for silver that they can actually fit on their balance sheet. And they are just getting started. But now I have to address the elephant in the room. I have to address the fear that is paralyzing half of the people watching this video right now. You are looking at the chart. You are looking at a 229% vertical line, and your brain is screaming, "It's too late. I missed the move. If I buy now, I am chasing the top." That is the trauma speaking. That is the PTSD from 10 years of bear markets whispering in your ear. Because if you zoom out, if you stop looking at the 1-year chart and start looking at the 20-year chart, you will realize something that should make your hair stand up. Even after a 229% explosion, Coeur Mining is still trading below its 2011 highs. First Majestic is still nowhere near its all-time highs. The entire sector is arguably cheaper today on a cash flow basis than it was when silver was at $25. simply because the profits have grown faster than the stock price. We are not at the top of a bubble. We are at the exit velocity of a depression. Think about the tech stocks. When Nvidia went up 200%, did it stop? No. It went up another 200%, and then another. Because when a sector undergoes a fundamental repricing, the move doesn't happen in weeks. It happens in years. And the mining sector hasn't even seen the dumb money yet. Right now, the people buying Coeur and Pan American are the hedge funds, the contrarians, the resource specialists, the smart money. But what happens when the generalist money shows up? What happens when the S&P 500 starts to falter? What happens when the Magnificent Seven tech stocks stop delivering growth and the pension fund managers in New York and London realize they have zero exposure to the only commodity that is up 170% in a year? They have to buy. They have a mandate to chase performance. They cannot go to their investment committee and explain why they missed the biggest rally of the decade. So they will panic buy. They will throw billions of dollars at these stocks without even looking at the balance sheets. They will buy the ETFs. They will buy the majors. They will buy anything with the word silver in the name. And because the sector is so small, because the consuming pool is so tiny, that wall of capital is going to push these valuations to levels that will seem insane to us today. We are talking about a potential mania phase, where price-to-earnings ratios don't matter and only exposure matters. This is the phase where the 229% gain looks like the warm-up. But, and there is always a but, this is also the most dangerous phase for the individual investor. Because while the trend is up, the volatility is going to be vomit-inducing. A stock that goes up 229% can drop 40% in a week and still be in an uptrend. Are you ready for that? Can you handle watching your portfolio drop by 6 figures on a Tuesday, knowing that it's just a shakeout before the next leg higher? The physical buyer doesn't have to worry about that. The physical buyer sleeps like a baby. But the miner buyer? The miner buyer has to have ice water in their veins. This is where the miner buyer and the physical buyer part ways. If you are holding physical silver, your job is simple. You do nothing. You sit on your hands, you look at your stack, you smile, and you wait for the currency to collapse. You have already won the game of preservation. But if you are playing the miners, if you're chasing that 229% explosion, your job is completely different. Your job is to survive the volatility tax. Because here's what the banks are going to do next. They know they can't stop the trend. They know the fundamentals are overwhelming. But they also know that retail investors are emotional. They know that if they can smash the paper price of silver down by $400 in a single morning, Coeur Mining will drop 15% in an hour. They will use the high beta against you. They will try to trigger your stop losses. They will try to make you panic sell your shares at the exact bottom of a correction, just so they can scoop them up before the next leg higher. We saw it on Monday. When silver dipped, the miners collapsed. It was a bloodbath. The weak hands were flushed out instantly. And then, the V-shaped recovery. The shares bounced back before most people could even log into their brokerage accounts. This is the gap risk I have been warning you about. In a market moving this fast, the biggest moves happen overnight. The biggest moves happen when the market opens. If you try to trade in and out, if you try to get cute and sell the top to buy back lower, you are going to wake up one morning and find that Coeur has gapped up 20% while you were sleeping, and you're left holding cash that is rapidly becoming worthless. The strategy for the miners in 2026 is not buy low, sell high. The strategy is position and hold. You have to decide right now, are you an investor or are you a gambler? A gambler looks at a 229% gain and says, I should take profits. An investor looks at the fundamental shortage of silver, looks at the leverage of the mining company and says, the asset is still undervalued relative to the future price of the metal. If silver goes to 100, and we all know it, S going to 100, then Coeur Mining at today, our S price is trading at a PE ratio of roughly 0. The earnings power at triple-digit silver is so high that the current stock price is a mathematical joke. So why would you sell? Why would you give your shares to BlackRock? Why would you let the smart money take your position just because the chart looks overextended? They want you to sell. They are begging you to sell. They need your liquidity to build their positions before the mania truly begins. And this brings me to the most important point of this entire video. The reason Coeur's shocking year destroyed. The physical buyer is not because physical is bad. It's because the physical buyer underestimated the speed of the repricing. We thought this would take years. It's happening in months. The window to build a position in the miners is closing, not because the price is too high, but because the availability of shares at these valuations is disappearing. When the masses arrive, when the Reddit crowd returns, when the CNBC Fast Money crew starts pumping silver stocks every night at 5 p.m., you won't be able to buy. You will only be able to sell to them at a massive premium. We are in the accumulation phase of the general public, and once they are fully in, that is when we exit. but we are not there yet. So we have established that the easy money has been made, but the big money is just arriving. We have established that the volatility is the price of admission. But there is one final catalyst for these mining stocks that nobody is talking about yet. And this is the catalyst that turns a bull market into a supernova: mergers and acquisitions. The big boys, the Barricks, the Newmonts, the massive diversified mining giants, they have a problem, a very big problem. They have been depleting their reserves for a decade. They haven't been exploring, they haven't been building new mines. They have been paying dividends and buying back stock to keep Wall Street happy. But now they are looking at $79 silver. They are looking at the same deficits we are, and they realize they are running out of ore. They cannot build a new mine in 2026. It takes 15 years to permit and build a mine in the West. If they start digging today, they won't see an ounce of silver until 2040. So what do? What does a desperate giant with a massive balance sheet do when they need ounces now? They buy them. They don't buy the metal on the COMEX. They buy the company that owns the metal. They are going to come for Coeur. They are going to come for First Majestic. They are going to come for Hecla. And they aren't going to pay today's price. They are going to pay a premium. A massive, desperate, we need this asset to survive premium. We are about to see a bidding war for the few remaining pure play silver producers left in safe jurisdictions. And when that happens, the stock prices won't just drift higher. They will gap up 30%, 40%, 50% overnight on the announcement. This is the end game for the miner trade, the consolidation phase. The phase where the small fish get eaten by the big fish, and the shareholders of the small fish get paid out in cash or stock at valuations that reflect the strategic value of the asset, not just the cash flow. And this is where the physical buyer gets left behind completely. If you own physical silver, you own the metal. That's it. Nobody's going to pay you a strategic takeover premium for the coins in your safe. You will get the spot price, maybe a few dollars over, but if you own the miner, you own the target, you own the scarcity. You own the only thing that the mining giants cannot reproduce, permitted, producing reserves in North America. This is why I say Coeur's 229% move destroyed the physical buyer, not because the physical buyer lost money, but because the physical buyer is missing the leverage of the corporate takeover cycle. You are sitting on the sidelines of the greatest M&A boom in resource history. So, am I telling you to sell your stack and buy stocks? Absolutely not. Your stack is your life insurance. Your stack is your freedom fund. You never trade your ounces for paper shares. That is rule number one. But new capital, fresh capital, the money you are looking to deploy right now, you have to ask yourself, do I want safety or do I want velocity? Because the physical metal is the shield. But the mining stocks are the sword. And in 2026, we are going to war. So here is the bottom line. The divergence has happened. The decoupling we warned you about is real. But it didn't just happen between paper and physical. It happened between the metal and the miners. You are witnessing a 229% explosion in Coeur Mining because the market is finally doing the math that the bullion banks tried to hide. The market has realized that a silver mine in 2026 is a money printing press in a world that is running out of ink. If you are a physical stacker, do not feel defeated. You have won the war of preservation. You have opted out of the system. You hold the only asset that has no counterparty risk. That 100-ounce bar in your safe is your sovereignty. Do not sell it to chase a stock tip. Do not swap your shield for a lottery ticket. But if you want to win the war of accumulation, if you want to participate in the greatest wealth transfer of the century, you cannot ignore the miners any longer. The sword and shield strategy is the only way to play this endgame. Your physical silver is your shield. It protects you if the brokerages fail, if the power grid goes down, if the government seizes assets. It guarantees you survive. But your mining stocks? They are your sword. They are the weapon you use to attack the inflation that is eating your savings. They are the vehicle that turns a $10,000 investment into a $100,000 legacy. The 229% move in Coeur was the warning shot. It was the market telling you that the train is leaving the station. The institutions are boarding, the smart money is seated, and the doors are about to close. When the retail mania truly hits, when your Uber driver starts asking you about Hecla Mining, when the frantic buying pushes these stocks to valuations that make no sense, that is when we will hand our sword to the crowd. That is when we will sell our paper shares to the latecomers and buy more physical metal with the profits. But we are not there yet. We are in the sweet spot. The fundamentals are screaming shortage, the charts are screaming breakout, and the masses are still asleep. You have a choice to make today. You can keep watching the price of Coeur Mining from the sidelines, telling yourself it's too risky, while the institutions bid it up another 100%. Or you can recognize that in a world of infinite fiat currency, and finite silver, the companies that own the silver in the ground are the most valuable real estate on planet Earth. The year of the miner has begun. The physical buyers have been left in the dust on performance, but they are still alive. The goal now is to be both, to be safe and rich, to be protected and aggressive. The silver squeeze is entering its most violent phase. The miners are leading the way. The physical is the foundation. Do not let the volatility shake you out. Do not let the banks scare you away. And do not let the opportunity of a lifetime slip through your fingers because you are too stubborn to adapt. I am Asian guy. The miners are exploding, the physical is disappearing, and the only thing you need to do is position yourself before the world wakes up. Like, subscribe, and share this video. The algorithm hates us, but the truth is unstoppable. I will see you on the other side.